Do you ever hear a friend talking about investing in the next big stock and immediately know he has no idea what he's doing? Well, that's because in the world of investing, you don't need to know the next big stock to be a good investor. Here's the brutal truth. Most people that are making these investment mistakes think that they're smart investors. And that's because some of the loudest advice that people are getting are coming from people with money, not from people with skill. And unfortunately, that money didn't come from investing. And so today, I'm gonna walk you through how to actually avoid these common mistakes. That crypto millionaire that invested in Bitcoin in 2013, amateur. That MBA who over-engineers their entire portfolio in a spreadsheet, also amateur. When you actually start to talk to real millionaires who successfully built out their investment portfolio, you'll notice that there's a huge disconnect between building wealth and buying assets. I've been studying personal finance for the last decade, not just the math, but the actual behaviors that lead to someone being financially free. And a big thing that I've noticed is you actually don't need to know anything about the stock market to be successful at investing. And at the end of this video, if you think that I missed a really important mistake, comment yes with what that mistake was, or comment no, you nailed it. Now, most beginner investors all make the same mistake. They want to start investing and they open up a brokerage account because it's easy and they think they're making some progress on getting started. But here's why that's actually a problem. A brokerage account offers you zero tax advantages. You pay taxes on the money that you put in, you pay taxes on any dividends that you make investing in that account, and when you finally do sell off your investments, you pay capital gains tax on that too. Meanwhile, there are other accounts that are designed by the government to help you build wealth faster. An IRA, a 401k, and an HSA are readily available for you to invest in. And here's how those would actually help you optimize for taxes. Well, a traditional IRA or a traditional 401k allows you to actually deduct what you invest from your taxable income today. A Roth IRA or a Roth 401k requires that you put in money that you've already paid taxes on, but when you do go to withdraw the money later on, probably at retirement, you would pay zero taxes on all the gains that you've accumulated while you've invested. And an HSA is the only triple advantage tax account, meaning you get tax advantages on the money that you put in, tax advantages on any dividends or money that you make within that account. And when you do go to sell off any of the investments, if you go to use that for qualified medical expenses, you also get tax advantages on that as well. That means that most beginner investors are choosing to spend more on taxes than they legally have to. And so if you invest $6,500 over the course of 30 years, well, in a tax advantage account, you'd basically get to keep all of that money that you're investing. Whereas using a brokerage account, you might be losing 25 to 30% of the potential gains that you could be making because you're not taking advantage of those tax breaks. And that's not an investing problem, that is a behavior problem, which you'll notice is a common theme with all of these mistakes. You see, beginner investors think that they need to be doing something with their investments, whereas real investors realize that they just need to not screw things up. In the book Millionaire Next Door, where they surveyed hundreds of millionaires, what they found is on average, these investors are holding their investments for years. Not months, not days, not hours, years. Contrast that with what a lot of beginner investors are doing, where they're holding a stock for less than a day, or even worse, they're trying to day trade, which is a very low likelihood of success. Even Warren Buffett has been quoted saying his favorite holding period is forever. Some of the investments that his company, Berkshire Hathaway, has been holding, they've been holding those positions for 20, 30, 40 years. And you're probably thinking, well, why would they do that? Well, that's because trading introduces more taxes, more fees, and more emotional decisions, which often leads to mistakes when it comes to investing. Studies consistently show that the more frequently that someone is trading, the worse that their portfolio does. You might think that buying and holding is boring, but I would consider it discipline, and so do most professional investors. Most people do intend to invest, but they don't end up doing it on a consistent basis, which is why automation is so important in your investment strategy. When money comes out of your paycheck before you see it, three things happen. One, you learn to live on less. 2, you actually invest consistently. And 3, you stop trying to time the market. And the data backs this up. A study done by Vanguard found that people who invest automatically end up with portfolios that are 20 to 30% greater than people with the exact same income as them. Again, consistency always beats intensity. You don't need to be an expert on the market, you just need to consistently invest in the market. Beginner investors think if I just could pick the right stock. But the reality is that even 93% of professional investors don't beat the market. And these are people with Ivy League educations, a full-time research team, and data that you're never going to have access to. So when someone says that they're trying to pick the right stock, what they're really trying to tell you is, I'm smarter than 93% of professional investors. Seems like an obvious amateur. Instead, you should focus on trying to own the entire market, and you can do so through index funds that provide access to thousands of companies, have lower fees, and give you access to a very diversified portfolio. Historically, these entire market index funds have returned 10% per year on average. That's not flashy, but that's consistent, and it will get you to exactly where you need to be with your investment portfolio. Time in the market always beats time in the market. Beginners will wait. They'll wait for a crash, a pullback, they'll wait for some sort of market correction. And while they wait, compounding interest just passes them by. Because the reality is if you miss the 10 best trading days every single year, you're missing out on 50% of all of the year's gains. Oftentimes, those best days actually come when there's the most fear, when the market has actually just recently corrected, and maybe you're a little bit hesitant to invest in the market. Time in the market isn't exciting, but it's actually how you build wealth. Beginner investors will ask, how much can I make? While experienced investors will say, how much would I lose? And am I okay with losing that amount of money? And the reason why they ask that is because a 50% loss requires you to get a 100% gain to get back to where you were. A big mistake could cost you years or even decades to recover from. The investors that win in the long term aren't getting the greatest returns today. Instead, what they're focused on is not panic selling, avoiding a catastrophic loss, and riding out the down markets. The reality is risk management is invisible when you do it right, but it's the key to actually getting compound interest to work for you. And if you are a beginner investor or someone who is looking to become financially free, like, subscribe, comment, all of those things help me get the word out, but will help my videos stay in your feed.